When I used to work in investment banking, almost every single analyst wanted to eventually crack into the buy side, which is kind of known as the holy grail of exit opportunities. And the buy side consists of three main industries, which are venture capital, private equity, and hedge funds. And I know you want to know how much these people make because you clicked on this video. And so looking at today's agenda, I'm first going to explain how buy-side compensation works, and then I'll go into the compensation figures for each of the three buy-side industries. Two quick things before I get started though. First, if you're interested in recruiting for investment banking, I'm selling my resume and cover letter that got me into JP Morgan and some industry guides I've created, which you can find down in my description below. And second, shout out to our sponsor for today's video, Wall Street Prep, a great resource for anyone who wants to learn more about finance. All right, with that said, let me first go into how buy-side compensation works. All three buy-side industries work in a similar way in that each firm will raise a fund and charge investors a small percentage called a management fee, which covers operational costs. And then the firm will take a performance fee, which is a percentage of the returns earned. And this is also called carried interest or carry for venture capital and private equity. Firms charged what's known as 2 and 20, which is a 2% management fee and a 20% performance fee. But given how competitive the buy side has become, it's not uncommon to see management fees go down to 1.5% and performance fees to 15%. To make this all crystal clear with an example, let's say a venture capital or private equity firm or a hedge fund raises a $100 million fund and earns a 20% return in 1 year. This means that from the 2% management fee, the fund would have $2 million to pay for employee salaries, office space, computers, and etc. And then from the performance fee, the fund would earn 20% of the $20 million in returns, which is $4 million that will be split amongst all employees. The tricky thing about buy-side compensation is that there's not a lot of transparency, and there's also a ton of variability depending on the firm, the number of people working there, returns for the year. And so today I'm going to provide you reasonable ranges for each of the three industries based on surveys that were published online and some discussions with my friends. Really quick before we go into the actual figures though, if you're interested in a job in the buy side or investment banking, then you're going to need to learn about finance. And one of the best resources out there that I highly recommend for technical prep is Wall Street Prep. Wall Street Prep has been around since 2004, and they train interns, new analysts, and employees at all of the top banks in the world. They offer a ton of different finance courses, and I'll leave a link to them in the description below. But the two I particularly recommend are the accounting course if you don't have any prior accounting knowledge, and then the premium modeling package, which has been taken by over 100,000 students. And this will go over all of the key valuation concepts I learned in banking, like DCFs, comps, accretion dilution, and LBOs. What I also personally really like about their valuation modeling course is that it has you dig into financial statements and build models using real numbers, which is what I did at JP Morgan. And so if you're interested in a course from Wall Street Prep, be sure to use my code rareliquid to get 20% off. I'll leave a link to all of this down in my description below. All right, now with that said, let's go into venture capital compensation. Every firm will have different titles, but the most common ones are listed here, and I won't go through every single position and number since you can just pause the video and take a look, but I do want to comment on a few things. First, the columns are broken down into title, salary, bonus, total compensation without carry, and age range. The total compensation doesn't include carry because carry is extremely hard to predict, and it can take anywhere from 5 to 10 plus years for a venture capital firm to exit out of an investment since they invest so early on into a company's history. With that said, as you grow senior, carry becomes a much larger part of your pay, especially at a good fund, and the value can range from tens of thousands of dollars annually at the associate level to hundreds of thousands or millions of dollars at the partner level. Looking at the age range for the more junior levels, analysts tend to join right after undergrad, though those positions are super rare. Associates join after 2 to 3 years in investment banking, consulting, or industry jobs. And senior associates and VPs are either promoted directly from previous positions or join after MBAs depending on a prior experience. The last comment I'd make is that, especially in the junior level positions, venture capital compensation is often lower than what you would make at an investment bank and lower than what you'll see in private equity firms and hedge funds. But even though this video is about money, it's not all about money. It's important for you to do work that you love, and people view venture capital, or some people do, they view the industry to be more exciting and thought-provoking than something like investment banking. It's really up to you. Also, if you do really well in the industry, then the sky's the limit in terms of compensation, because you do see venture capital billionaires, but you don't see managing directors at top investment banks who are billionaires. All right, now next up, let's go into compensation for private equity. Private equity firms have very similar hierarchical structures as VC firms, and I'll let you pause the video here again if you want to take a look at all the numbers. To add a few comments though, first, the total compensation does not include carry because it's super unpredictable, given that it takes on average 5 years for PE firms to realize profits and exit an investment. Carry also becomes increasingly higher as you grow more senior at the firm, with the value ranging from tens of thousands of dollars annually at the senior associate level to hundreds of thousands, if not millions of dollars at the principal and partner levels. With respect to age range, for the more junior levels, analysts join right after undergrad, though those positions are also super rare, just like in VC. Associates join after 2 to 3 years in investment banking or consulting, and senior associates and VPs are promoted directly from previous positions or join after MBAs depending on prior experience. Something also important to note about private equity compensation in comparison to venture capital is that your salary and bonuses are a lot higher in general, as you can see when we compare the two. The reason for this is that private equity is a much more stable industry. So in venture capital, you're investing in young, hot startups, and they could 100x your money, but a lot of your investments are really going to just go down to zero. While in private equity, a lot of the investments that you make are in mature companies with stable cash flows. So your returns are going to be lower on average, but you're going to have more stable returns. By the way, if you're interested in learning more about venture capital, feel free to check out this video right here. And I'm also going to be publishing a what is private equity video pretty soon. So feel free to hit that like and subscribe button if you don't want to miss that next video. All right, now last but not least, let's go into hedge fund compensation. Hedge funds have pretty different structures and positions in comparison to VC and PE firms. And let me comment again on some key takeaways here. First, you can see there are much fewer titles, and most hedge fund investors just call themselves analysts until they become sector heads or portfolio managers. Looking at the age ranges, the junior analyst position is right out of college and is extremely rare, and most join as an analyst after investment banking, private equity, or an MBA. As you can tell from the bonuses, hedge funds are super performance-based. And so if a fund has negative or zero returns, it's very possible that after an entire year's worth of work, no bonuses are given out to anyone. And oftentimes funds can shut down after a really bad year, like Melvin Capital. On the flip side, if a firm has a blowout year and you're a hedge fund star, you can make a lot of money much more quickly than essentially any other job in the world. Because of all this uncertainty, there's a ton of pressure when you work at a hedge fund because one small mistake could cost millions of dollars. But of course, on the flip side, a really great call could also earn millions of dollars. In case you wanted to compare the three industries, here are the compensation figures for each, and you can pause the video now to take a look at them. I'll also leave a link in the description for you to download the Excel I use to make all these tables. You can download them for free. Just feel free to check out my description. All right, now before I let you go, a few quick reminders. First, if you're interested in buying the resume and cover letter that got me into JP Morgan, feel free to check out rareliquidcareers.com. Second, if you want to learn about financial modeling, valuation, pretty much anything finance related, there are a ton of great courses at Wall Street Prep. You'll get 20% off if you use my code rareliquid. And lastly, if you're interested in learning more about the top 10 jobs in finance as I perceive them, then feel free to check out this video right here. And with that said, thank you all so much for watching. Hope to catch you all in the next video. Thanks so much, guys, and peace out.